Hey guys, it's Rudy. What I'm going to do today is give you a quick comparison comparing ConocoPhillips and EOG Resources and Oxy to one another. Now, to be fair, I know that ConocoPhillips basically announced earnings today. So what I'm going to do is I'm actually going to use the earnings from the previous quarter, just to have a fair comparison, because the EOG earnings is coming up November 6th, I think it is, and Oxy is reporting on November 9th or 10th from memory. So coming up within the next week or 10 days or so. So what I'm going to do is effectively just compare using the previous quarter as opposed to Conoco's results that were announced today. So on the earnings call today, just as a reference point, Conoco missed on earnings per share a little and missed on revenue by quite a bit, 12%, which was significantly better to the previous quarter that they reported. And that's the quarter I'm going to use for comparative purposes, because that way I can compare apples with apples and look at ConocoPhillips, EOG Resources, and Occidental Petroleum based on their quarter that ended in June, which was obviously quite a devastating quarter for energy in general. So just firstly, just to kick it off, this is a quick graph, and you can kind of see how these three oil stocks have been following each other. Oxy had the greatest benefit of that spike that happened in June when there was some good news from a supply and demand point of view, and also OPEC had at that point in time announced that they were not going to increase their supply. So that was a day when all three of them spiked. And after that, the trajectory for all three of them pretty much follows the same line, except that Oxy got punished more than the other two. And you can arguably say that that's also as a result of their very, very disappointing Q2 earnings report. So let's take a look at the three, and I'm going to keep the same order throughout. So I have the header here that says ConocoPhillips, EOG, and Oxy, so they're in that order, and I'm going to keep it that way through the presentation until I get to the last couple of slides. Very briefly, all of them trade on the New York Stock Exchange. You can see the current price for for Conoco is sort of in the $27, $28 range. EOG sort of 31, 32 thereabouts, and Oxy dipped below $9 yesterday and is trading sort of in a narrow band around $9 per share, which is very disappointing. And we're probably going to have to bite the bullet on that until we get to the Q3 earnings report to see what happens, or how the stock is impacted at that point in time. A lot of volume being traded on the stock. Obviously, Occidental, almost 10 million shares, as an example, would be you'd expect it to be trading more because of the relatively low stock price. It's cheap at less than $10, and the volume has been high. Conoco also quite high, 4.5. But look at the 20-day average volume down here. Average 10 million shares trade hands on Conoco per day, about 6 million on EOG, and 22 million on Occidental Petroleum. So we look at the 20-day moving average. You can kind of see it mirrors the stock prices that I just mentioned a minute ago. There's some technical references here, which I'm not going to dwell on for the purposes of this presentation, except maybe weighted alpha, which I highlighted here at the bottom of the screen. Alpha describes an equity's ability to beat the market, or otherwise you can say its edge. Negative 45, negative 47 is about the same. Occidental's ability to beat the market is pretty poor at negative 75. I don't think anyone would be surprised if I reference the fact that all the the marketplace opinion, including the analysts, are all saying sell, 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 which is usually the time when contrarian investors potentially look to buy, 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 buy. 5-day performance. Conoco down 10%, EOG down 11%, Occidental down just over 11%, so pretty much the same. If we look at it for the past 1 month, ConocoPhillips down 11%, EOG 9%, OXY almost 10%. And here's the big difference though, over 3 months, Conoco down 27, EOG 32, but OXY down 47%. And that is primarily the 3 months drop. This says since July the 29th. And obviously we know that OXY had a very disappointing second quarter, which plays into it for sure. But at the end of the day, they're all down and they're all being punished. Key statistics, very quickly, the market cap for Conoco, a respectable 30 billion, and for EOG, a respectable 19 billion, and for Occidental, a very arguably undervalued, $8 billion market cap. It's hard to believe that Occidental and Anadarko together could be worth $8 billion. Something's horribly wrong in that valuation, but there's also a difference between the market valuation and the fundamentals of the stock. So I'm just going to leave that there for now because, as I said, the earnings for the third quarter is coming up soon. Annual sales, Conoco 36 billion, EOG about 18, and OXY a little bit above that at just over 20 billion. Net income, nice performance by ConocoPhillips at $7 billion, EOG respectable at almost 3, and Occidental negative. Last quarter sales, same thing. Last quarter net income, this massive $8 billion loss that Occidental had included a $6.6 billion impairment charge or write-down, which is like depreciation, where the issuer is basically saying, this asset on my books is arguably worth nothing or very little, so I'm just going to write it off. And you're allowed to do that under GAAP, so you just take the hit. And hopefully they won't have another impairment charge in the third quarter. So the net income or loss for the quarter should look a little bit better. 60-month beta is an interesting one. So 60 months obviously is a period of 5 years. Beta, just for people who don't know, is the measure of the volatility or systemic risk of a security compared to the market. As a general rule, 1 equals 1. So if your beta is 1, that means your level of volatility or risk is kind of matching the market. If it's greater than 1, that means it's more than the market as a general sort of average. And you can see Conoco has a beta of 1.7 and OXY about 1.9, and EOG slightly higher beta at 2. Price share information. This was the most recent earnings. As I said, I'm comparing apples with apples because I wanted to compare Q2 for all of them. Conoco came in at negative 92 cents, EOG at negative 23, and OXY $2.29. It'll be interesting to see what that change looked like for EOG and OXY when they report in a few days from now. There's the next earnings day coming up that I referenced at the start of the video. Conoco obviously reported today. EOG is coming up next week, and then the week after that is Occidental. The dividend, we know Occidental had slashed the dividend down to 10 cents, 1 penny per quarter. That's 4 cents per year, whilst both Conoco and EOG are still paying a very respectable dividend for dividend investors or investors who are inclined to have a dividend as part of their investment thesis, which, by the way, I do too. So I want to see Occidental kind of return to normal and preferably ASAP. At the same time, though, I'll counter that by saying I don't want to see Occidental just suddenly declare a dividend again before they get themselves out of the woods in terms of servicing the debt and other more pressing issues, including things that you cannot control, like the price of WTI. The ratio, price-earnings ratio, Conoco 27, too high for me. I'd like to typically look at an investment PE ratio as a starting point, sort of maybe around 15. If it's slightly less than 15, like EOG at 12.35, it's immediately attractive to me. So just based on the PE alone, I would almost default to EOG as a preference here to Conoco, just because the PE ratio is something I look to as an earnings ratio that shows me whether the company is over or undervalued. I did add a definition here, which I took from Investopedia, just to give you a quick highlight in terms of what it means. A high PE ratio could mean the company stock is overvalued. I'm not saying Conoco is overvalued. I just said this is my starting point in terms of making a decision from an investment point of view, or else that investors are expecting high growth rates in the future. So that might be true of Conoco. And given the fact that all three of these are effectively undervalued, that might be the reason for the PE. So I did not do a deep dive on it. I'm just giving you a starting point for my investment thesis. Companies that have no earnings or that are losing money do not have a PE ratio, since there's nothing to put into the denominator. And there you can see, obviously we know Occidental Petroleum's share price is around $9 or thereabouts, but there's no earnings, so you can't divide something with nothing, so you end up with a zero. So based on like this slide, for instance, if I didn't have a position in any energy stock and I wanted to enter one today, my starting point might be to start looking at EOG as an example. I thought to take a quick look at the debt from a valuation point of view, and this is Conoco versus the industry. Total debt to capital ratio below the industry. The industry is at 42%, Conoco at 32%. Change in debt over the quarter. Nice job, Conoco. Well done. The quick ratio, 2.45. Quick ratio means it has enough cash and cash equivalents in order to settle its debt. If the quick ratio is more than 1, that means they have enough cash and cash equivalents to pay their debt if they had to right away. You'll see the industry as a whole is actually below 1, which means the entire energy industry right now does not have enough cash and cash equivalents to pay their current liabilities if everything were due today. And then the interest coverage for the most recent quarter, Conoco scores a little double dot. EOG comparatively, once again, total debt slightly below the industry. It's actually a good number. EOG is at 22%, the industry is at 42%. Change in debt, also a good change in EOG's favor. The industry is at 0.74, EOG at 0.12. The quick ratio here, good position for EOG to be in. They are at almost 2 times the current liabilities if it were called on today. And then you can see the interest coverage for EOG, negative 14 compared to the industry's 1.48, negative. And then Oxy, and of course this was the sort of Q2 elephant in the room, like how much debt do they have and what is their ability to pay it, which led to some people saying, is Occidental going to go bankrupt? Now, most of you know by now, especially if you've been following me, that Occidental has done a whole lot of stuff in order to get themselves out of this awful debt situation that they were in as a result of the acquisition of Anadarko. I'm not going to dwell on this because most of you already know, but just very briefly, they had about $1 billion in the bank at the end of June. They had a $5 billion facility that was undrawn, so that was available. They've sold off some assets and they exceeded their asset divestiture target. They had a debt note tender offer, which also put some cash in the bank for them. They did the announcement that they made in, I think it was August, where they said they have enough cash to pay Warren Buffett's $200 million coupon for the quarter in cash instead of issuing new stock, which is good news for investors because that means they're not going to dilute the existing shareholders by issuing more common stock. So anyway, I said I'm not going to dwell on it, but that's kind of like sort of 5 quick highlights in terms of the highlights reel. Oxy change in debt. So this is going to be an interesting picture as well when they report for Q3, and you can see it was sort of in line. I mean, you can see it on the actual little graph, but you can see it was sort of in line with the industry. Oxy at almost 0.9 and the industry at 0.75, so there or thereabout. Oxy is lagging the industry in terms of its quick ratio. I mentioned earlier that you want to have a quick ratio of 1 or greater than 1 in order to demonstrate that you have enough cash and cash equivalents on hand to easily settle your debt if it became due immediately and or today. And then Oxy's interest coverage for the most recent quarter also lagging the industry as a whole, the energy index specifically, as it were. So guys, that's my quick wrap here on ConocoPhillips, EOG Resources, and Occidental Petroleum. If you have watched this video, let me know in the comments if you would buy or sell any of these, or if you have a preference for one versus the other. Most of you know by now that I have a reasonably substantial position in energy stocks as a whole. Occidental obviously makes up one of those. The other three that I can quickly mention to you is Pembina Resources, Enbridge, and Total. Pembina and Enbridge are both Canadian corporations. They're a little different, one compared to the other. They're also different to Occidental. And the other one that I own is Total, which obviously is a French major in terms of the energy market today. Anyway, let me know if in the comments, do you like one of these three more than the other? Are you currently invested in one of them or all three of them or whatever the case might be? It'd be interesting to learn from you guys. And if you like my videos, please subscribe and let's stay in touch. And I look forward to hearing your comments and hearing what you have to share with me once we get an opportunity to chat. So on that happy note, have yourself a great day, and we'll see one another soon. Bye-bye.